welcome to Capital Market Ambush with your host Rob Thielen.
And Aanchal and Angel.
Alright, today we're going to hit up 3 different locations, and let's start at Murphy's. What do you want the subject to be, Aanchal?
Option contracts.
Option sounds perfect. Alright, let's do it. Murphy's. Hey, how's it going? I'm Rob. Hey, I was wondering if I could take a minute of your time to explain option contracts to you.
Very good. I'm all ears.
Alright, so let's say that the price of beer varies from day to day. And this is, from a student's standpoint, this would be pretty bad, right? Because, you know, one day might be $2, one day might be $6. So I want to find a way to kind of hedge my bets on this. So when I come to you and I say, hey, is it possible to buy an option contract for beer? I give you $1 for the option contract, and it's got a call price, let's say $4. So that means if the price of beer is above $4, I can say, I want to use the option contract, and I get the beer for $4. If it's below $4, at like $3, then you still have $1 in your hand. So it's kind of like a win-win. Now, the things that option contracts have, they all have an expiration date. So I can only buy this for maybe a month from now. So this option will expire in, let's say, January 1st. And it's got a price, it's got a strike price of $4. So you write the contract out, and you are giving me that. So you're the writer of the contract. Then I can use that contract for whatever I want. I can sell it to someone else. Or I can hold on to it and use it. So let's say this is the beer, and the price right now is $6. I'm going to use the option contract. And now I pay you $4 for this beer. So I am in the money in that circumstance. Right. If not, and it's at $2, then I'm not going to use it. So I'm out of the money. And if it's at exactly $4, I may or may not use it. Because, I mean, honestly, it may not be worth my time. So I'm at the money. So that is an option contract. Cool?
Got it. And you know what? The option is to drink it now.
Thank you. Having enjoyed a delicious option price beer, it was time to go get something more delicious to eat. My bet is Boloco will probably have some people in it. Are you ready, Aanchal?
Let's do it, Rob.
All right, Boloco it is. Let's do it. Pardon me, ma'am. You have 2 minutes?
Yeah.
Awesome. So I'm going to explain to you how to value a stock. Have you ever wondered what that was? Or how to value a stock?
Yeah, I have no idea.
All right, so there's 2 different ways to value a stock. You can either look at the future dividends they're giving out or the future free cash flow. Now, this is the cool part, is that if we look years into advance in future free cash flow, we can discount that back to the current stock price, divided by the number of stocks that are out there. Now, this is where it becomes really cool, and you're going to love this fact. So, into perpetuity, when things are increasing, let's say a stock is increasing at 3% every single year, and that increases to 4%, the value of the stock will skyrocket because, you know, that 4% is compounded year after year. Vice versa, if you don't make that target of 3%, make 2%, the stock's going to plummet. So the next time you see Facebook stock and you see that like $78 a share, you know that your free cash flow into the future must be huge because $78 a share divided by the hundreds of millions of shares that they have out there means that they must have tons of value out there. And given that's a tech stock, must be pretty risky. I would go into the capital asset pricing model right now to explain how you discount that cash flow. I'm not going to do that because we only have 1 minute to explain this. Do you have any questions? I'm sorry. Boy, that was fun and delicious. Where to next, Aanchal?
Let's go over to the den, Rob.
That sounds like a lot of fun. All right, so let's go to the den and talk about the term rates of interest.
Do you mean term structure of interest rates?
Yeah, whatever. Let's go. Hey, how's it going?
Good.
My name's Rob. What's your name?
Rose.
Rose, awesome. I was wondering if I could explain a quick financial principle to you called term structure interest rates.
Sure.
It won't take a minute. All right, let's do this. So basically, you know, you've probably heard of like the interest rate markets and maybe bonds, but you might not know what it means, like what a yield curve is and all that kind of fun stuff. So I'm going to explain why it's important and what you should look for to know kind of what's going to happen in the economy in coming months. So we have these different things called treasury strips. What it is you basically you pay a amount of money and you get a So this is basic term structure interest rates. You know, as upward sloping yield curve is good, and it means that into the future, good things are going to happen. If you see a downward sloping one, bad things, and again, neutral, it's kind of a very unique circumstance. Do you have any questions?
No.
All right, awesome. I'll see you later.
Thank you.